Ladies and gentlemen, it is my pleasure to introduce our first speaker today, Brian Dandy. Brian Dandy is the Compliance and Marketing Officer at Zimnat Life, and he has vast experience in financial planning, and he's bringing a wealth of knowledge and experience to today's discussion on how to stretch your salary. Please join me in welcoming Brian. Over to you, Brian.
Thank you very much, Eve, for a very good and pleasant introduction. As you rightly said, my name is Brian Panashe Dandy. I'm the Compliance and Marketing Officer for Zimnat Life Assurance. But for the first part of the slides, I will allow Simbarashim Sukumizwa, who is our Business Development Manager, to take you through the statement financial planning, getting started with savings and investments. Over you to Simba.
Thank you, Brian, and apologies for that slight change in terms of the order of our presentation. My name is Simbarashim Sukumizwa. I will be taking you through the first section of our presentation. So this is just to set the tone for the rest of the other speakers who are to be also sharing the stage this morning. So I'll just be giving you an overview of what financial planning really is. Just to simplify it, you would agree with me that everyone requires a plan in their life, be it marriage. You know, you get that list, that Lobola list. It's a plan. Be it you want to build a house, you also have to come up with a plan of some sort. And for building a house, you actually have got to get the services of a professional who then does the drawings for you, and they call those guys architects. So you get your architect, he drafts the plan for you, then it also gets certified. So you find out that once you have a plan, you now know the number of rooms you require in your house. And from that plan, you can also come up with what they call a bill of quantities, which really is transforming that plan into figures. You now know how much number of bricks you require to complete the house, how many windows you require, and how many bags of cement you also need to ensure that you complete that house. So in that same vein, as human beings, as people, as individuals, we also require to have a financial plan. So that in short is my simple definition of what a financial plan is. And that financial plan is it has got basically a few pillars, 5 pillars to be specific. And just like that example I've given you of building a house, you need to do the foundation, which can be a pillar. You do the structure, the roofing, then the interior and the finishes. So it's the same with the financial plan. It also has those 5 pillars, which is income planning, investment planning, tax planning, insurance planning, and lastly, estate planning. And just to give you an overview of what each pillar entails. So income planning, what you are basically doing under income planning is, this is where you are managing your cash flows. And what I mean by that is your income, for most people, it's usually through a salary, a monthly salary, and maybe a business or some side hustle if you have one. So that will be your income plan. So what you're saying is, how much do I earn per year or per month, rather, or per day? So if you've got a business that's giving you daily income, you are also then putting down, you know, that projecting your daily income. Is it $100? Is it $200 per day? Then you have it per day, per week, and per month. Now that you know all your income streams, you are also now looking at the expense line to say, how much am I expensing? How much am I using in terms of expenses? Is it fuel, groceries, rates, etc.? So you are then now using that as the dashboard, and it then becomes easy to check where you are spending more money and spending less money, so that at the end of the day you won't have a situation where you have a lot of you spend all your money before the month ends. Then in terms of investment planning, now that you'll be done with your income planning, uh, you have set aside how much you are earning against what you are expensing. Then whatever is left, which then becomes your savings, you are now deciding to say, I now have 1,500, 2,000, 5,000, 10,000 that I've saved in the past 2 3 years. What should I do with it? How do I make it grow? How do I make it earn more money whilst I sleep? That's investment planning, which is the next pillar. Then the third pillar is tax planning. What you're now saying is, as I'm looking at my investments, which investments are more tax efficient or allow me to pay less in terms of tax? That's when we are talking about tax planning. So we've got investments such as retirement income plans or retirement investments. Those are usually tax exempt. So when you've got a retirement plan, you end up paying less tax to ZIMRA, which is the same again with insurance. Insurance is another tax deductible pillar. So whatever you pay out as insurance, if you've got a business, you actually have got to sign some forms with ZIMRA so that they pay you back part of what you would have paid them as tax. Then again, under that insurance pillar, Isaac will also then talk about insurance later on. But just to give you a high-level overview, you are now looking at your assets and asking yourself questions like, how am I exposed? What risks can actually happen? Could it be death of a loved one, a parent perhaps, or a spouse, or a close relative? How can I protect myself from that? Maybe you are now thinking of issues like your funeral insurance plan, be it your house. These days with electricity challenges, people are resorting to alternative sources of power. So you'll find that most people have got solar systems at home. They've got, those lithium batteries. But the other challenge with those lithium batteries is technically you are keeping a potential bomb in the house. So we've had a lot of instances where houses are being burned down because of these lithium batteries. So imagine you have struggled for the past 10, 15 years to build a house only for it to be, bent down by a $500 battery or solar system. It would be so heartbreaking and a huge financial loss. But Isaac will talk to you about that. So you also have to ensure that you are protected, your assets are protected in terms of insurance. Then lastly, there's what we refer to as estate planning. We are also saying you need to plan for your whatever you would have earned whilst living, your whole estate or your whole wealth. You might be having 10, 20 houses, 5 cars, etc. All that wealth you have. You need to plan for it. What will happen to it when you are gone? That's what we call estate planning. It talks about wills and inheritance and related issues. You wouldn't want, family and relatives fighting for your wealth when you are gone, whilst your children are languishing in poverty. So just as a high-level overview, these are the major 5 pillars in terms of financial planning, and we'll also then just be talking about just a few of these pillars today. And what is the importance of financial planning really? I think I've already given a high-level overview in terms of that analogy of a house plan. But to give you a different pictorial image of the importance of financial planning, think of a financial plan as a map or as Google Maps. You have been invited by a relative, maybe you've never been to Bulawayo or to Mutare as an example, and they've just given you the location of the place. So the map then becomes your guide. So if you've got your financial plan, it then guides all your decision making, all your investment decision making, what you should cut in terms of expenses, etc. So that's the importance of having that plan. It then acts like as a map just like we use, Google Maps. Then again, it also gives you, that financial independence, because if you've got a financial plan, you've got the bigger financial goal to say in 5 or 10 years, this is what I want to achieve. I need to build a double-story house. But for me to build a double-story house, what do I require? I require 50,000 bricks. So you are now working towards that. So the financial plan becomes your beacon, the main goal that you are fighting towards. And also it gives you capacity to build emergency funds. You wouldn't want a situation where you have an emergency, you've got a sickness in the family, you want to rush to hospital or other forms of emergency. Then you are now moving around, calling your friends with a begging bowl. But if you have got an emergency fund, then you will be able to take care of such expenses. Then ultimately, if you've got a proper financial plan, it leads to financial wellness, and ultimately leads to mental wellness. So if your finances are in order, emotionally you'll be okay, because you will not be stressed. You won't have a situation whereby it's month end and you are stressed, because you've already planned for it by having a proper financial plan. And lastly, the importance of having an income plan, which is the first pillar under our financial plan. Like they say, the best form of an income plan is having a budget. So if you create a personal budget, that is the best form of an income plan, because what then the budget does is it helps you measure and manage your expenses as well as your income, because you will be knowing that if I can't earn more income, I've got to manage my expenses. That's the beauty of having an income plan. And as they say in financial planning, what gets measured gets managed. So if you are able to measure both your income and expenses, you are then now also able to manage them more. Unlike a situation whereby you don't even know how much you have spent per day or per month. That will lead us to the old adage that Mariam Gurutorwa Nechkwambu. But the biggest kwambu is actually not having an income plan. So lastly, you have got to understand your debt priority. So you have to look at your debts. If you've got an income plan, what it does is you'll be able to rank your debts. How much am I owing? How much do I have in terms of debts? Then you prioritize your debts and you start pay with the lowest debt, from the lowest up to the highest. It's a concept referred to as debt snowballing. So what you're basically saying is you are getting rid of the smaller debts, so that whatever you were paying towards those ones, you are now you now have more muscle to pay for the bigger debts, so that you can quickly extinguish whatever you are owing as debts. So I would say that's a high-level overview of the importance of having a financial plan, as well as the importance of having an income plan. So what I will do for now is give it over to Brian, so that he can take you through the next phase of the presentation in terms of how to grow your savings. Then possibly we can then take questions after that. Over to you, Brian.
Thank you very much, Simbarasham Sukumidzwa. Thank you very much again, ladies and gentlemen, for joining us for this webinar. So, getting into our presentation, we want to convert people from being impulse buyers to conscious consumers. And the thing we are trying to achieve is mastering your spending. So, the first aspect we are going to look at is what is an impulse buyer. By definition, an impulse buyer is someone who makes purchases without planning or much thought beforehand. They are driven by sudden urges to buy something, or often triggered by emotions, attractive marketing, or thrills of a good idea. I think most of us are well versed with the term impulse buyer, because we might not have an idea that we are impulse buyers, but we'll be actually impulse buyers in our natural systems. Take, for instance, that you get your salaries on the 28th or on the 30th or on the 25th. You end up going into a shop and do unplanned purchases. This is where people start buying things which are not necessary, things that we do not need, things that we have just seen on the shelf and think that we want them in our households. And then some other people are influenced by emotions. By emotions, we're saying that you're actually buying something to cover some void which has happened in your life. It might be a heartbreak. I think we are most common with the AMA 2000s, and everyone is facing the Mjolo era. So you see that people are actually buying things in an event to try to run away from emotions which they are suffering from. Maybe it's after losing someone which is very dear to your heart, and you try to comfort that void by buying things, or you're actually happy. You just got married and you're trying to fill in your house so that when people come to your house, they actually see that you've got a lot of property. These are some of the issues which actually characterize people to become impulse buyers. And then other things are actually market triggers, something which is eye-catching. For instance, you can be driven to buy something from just an advert. An advert itself can lead you to buying things which you do not necessarily need at the moment, but it is because of that advert that makes you want to take this product and bring it home. Because the product itself will be eye-catching and it will be screaming to you, take me home. So impulse buying can be harmless for small purchases, but it can also lead to financial strains if not managed. And also, these are some of the common impulse buys that individuals make. For instance, people actually buy more groceries than food that they necessarily need, and they end up throwing away these commodities once they hit their expiry date. Clothes is also an example. You find out that you buy a clothing item which you might wear once a year, and due to us not exercising everything, we end up gaining weight and we do away with those clothes. Household stuff, takeaways, shoes, partying and going out, and cosmetics also are some of the things that characterize as impulse buys that individuals make. And we go on to a conscious consumer now. A conscious consumer is someone who makes thoughtful purchasing decisions with a focus on the impact of their choices. So when you are a conscious consumer, what do? Number one, you prioritize your needs against your wants. Number two, you focus on the quality against the durability. Number three, you look at the support, you supported ethical companies. Number three, you reduce your consumption. And lastly, which is the most important thing, you make informed decisions. So informed decisions are the drivers that make you come to a decision to want to consume something. So this is in a nutshell what constitutes or what makes up what we call a conscious consumer. And then the major impact we want to drive to today, ladies and gentlemen, in our presentation is being able as a person to transform yourself from being an impulse consumer to a conscious consumer. How do you take yourself from being someone who just buys for the need to buy to someone who buys based on an informed decision? Here are the necessary steps which are involved. Number one, you recognize your triggers. What it is that makes you try to buy without making an informed decision. You identify situations in your past previous purchases. What is it that made me buy something? What is it that made me buy this headboard? What is it that made me buy this yogurt? If you identify such situations, it can allow you to make your informed decisions such that in the next occurrence that you meet such a similar incident, you will not be forced to buy something which you do not necessarily need and want. Number two is understanding your emotions. If you understand your emotions, you can easily trigger yourself that this is an emotional purchase. Allow yourself to exhaust that emotion, and then you'll be in a position to make an informed decision going further. Number two, you need to implement budgets. What do we mean by implementing strategies? Strategies can involve creating a budget. As you can see, this is just a snapshot of what a budget is. You can take your total income. Let's assume you're getting 2,000. You split it down on your expenses which are fixed and the expenses which will be variable. Fixed expenses are things that do not change in your life every day, which include your rent, your food, your transport, which include the school fees. These are something which are already constant in your life and will not change. And the variable things are the things that we have control over in our life. Things which involve like going out, eating out with friends, partying. Have a variable budget and see what is going to be left when it comes to your savings budget. Number two, you need to embrace the wait rule. If I do not purchase today, why not make the decision tomorrow? You might have a different opinion when it comes to the decision tomorrow. That's embracing what the way through is. And also you need to unsubscribe from temptation. If you're tempted, if there's temptation to making a purchase, you should try to implement what we call the way through, as I indicated earlier. Number three, you need to cultivate conscious consumer habits. Research before you buy something. You need to prioritize what you need over what you want. Number two, you need to invest in quality. Investing in quality means you are buying something which is durable and you'll be able to continue to use that thing for a long time. Let's take, for instance, that you buy your TV, you buy your sofas from TV sales and everything. Sometimes you might end up going to Highland to do those cheap purchases, but do they last you long? Do they give you that durability that I can go for 3 to 5 years? Why not go and buy a commodity which has a warranty, that should anything happen to that commodity, do I get a warranty before the warranty period is over? If I am able to get back a TV lost with a warranty of 1 year in 9 months of purchase, does this amount what we call an informed decision? Yes, it does. Sometimes you should consider alternatives. Instead of going for A, why not go for B? They might not meet the same purpose, but it might meet the need that you want to do at the current moment. So basically, in a nutshell, this is what we are looking at when it comes to transforming yourself from being an impulsive consumer to a conscious consumer. And then lastly, you need to learn to reward yourself. Track your progress and reward yourself. If it is a piggy bank, give yourself a target that by the end of December, from January to December, if I'm putting a savings allowance of A, B, C, D in my wallet, by December, how much do I have? Was I able to track my spending? Celebrate your milestones. If you want to curb your spending to $100 per month, if after 6 months you look at your spending habits and you see that instead of spending $600, you have spent $500, celebrate those milestones, because you have gone actually a long way to trying to accomplish everything that you have done. With celebrating and rewarding yourself comes self-actualization. That's the major purpose that we want to achieve when we become conscious consumers. Apart from that, ladies and gentlemen, this marks the end of the presentation. I would like to thank you by reminding that you should remember becoming a conscious consumer is a journey, not a destination. There will be setbacks, but by being mindful of your triggers and implementing these strategies, you gain control of your spending and make choices that reflect your values. Keep these few words in your mind. It will definitely take you a long way when it comes to being a conscious consumer. Isaac, coming up next, will give you some of the mitigation measures which you need when it comes to stretching your financial budget. Thank you very much.
Over to you, Evelyn.
Wow, powerful insights there. Thank you, Brian. You brought in a unique conversation to today's discussion. Ladies and gentlemen, Simba did speak about 5 pillars that are key in financial planning. He spoke about income planning, investment planning, tax planning, insurance, and lastly, estate management. Simba is very passionate about these issues of financial matters. Do we have any questions from the floor? Any questions, any comments? Brian also brought in unique insights to today's discussion. He spoke about impulse buyers and conscious buyers. Thank you, Brian. I actually discovered today that I'm an impulse buyer. But from today's session, I think I'm going to transform from being an impulse buyer to a conscious buyer. I have exciting giveaways for the audience. Simba did speak about snowball debt clearing. Is there anyone who remembers what snowball debt clearing is? I do have exciting giveaways for the audience. Anyone from the audience? There's a hand up from Munashe Gahadza. Please go ahead.
Okay, so I think it's the process whereby you look at your debts, so you evaluate them, and then you start by clearing small debts such that you leave room for clearing big debts.
Thank you, Munashe. Simba, please confirm. From what I heard, I think Munashe is right.
Yeah, if this was an exam, that would be an A+.
Thank you, Simba. So Munashe, you get yourself a free giveaway. We'll be in touch with you after this session. There was also a response in the chat box from Nyasha Mamboa. Nyasha says it's clearing small debts first. Simba, do you think Nyasha deserves a giveaway?
Yeah, I think Nyasha will also get an A++.
Thank you. If we do not have any further questions from the audience, I would like to introduce our next speaker, Isaac Zinanga, who's the Business Development Executive for Zimnat General Insurance. Isaac is also bringing in a unique perspective to today's discussion. A warm welcome to you, Isaac. We are delighted to have you today, and we are eager to hear what you have to share. Over to you, Isaac.
Yeah, thank you, Eve, and welcome everyone to this exciting session. Yeah, you have heard quite a lot from the previous presenters, and I'm just going to bring in the general insurance perspective. People would probably want to say, well, general what? So general is simply talking about the property and casualty. We are talking about things that we can see. We are talking about things that may happen. So I find my colleagues, some of the issues that they spoke about, there are things that will eventually happen. But when we now move to the general insurance, some of the things may not happen. So I'll be taking you through a small presentation, but this is just to have something on the screen. Much of the things, I think I would prefer it to be more of a discussion. If there are any issues, there are any problems, please, or any points of clarification, let me know as I go through. So maybe just to start by talking about what is insurance. Insurance is simply one of the risk transfer mechanisms. I'm sure you've heard about risk, and I would want to define risk as anything that then prevents you from achieving your objectives. So we can say deviation from normality. So if you've got your objectives, if anything then happens that hinders you from achieving your objective, we call that risk. So a risk can actually be good or it can be bad. So we've got positive risks and negative risks. Why? Because I'm talking about deviation from the expected result. So if, say, you want to achieve 20 in terms of the profit, and then you achieve 15, then we say the risk is bad. But then if you achieve 25, we say it's good. But however, it is very important to say that even the good, it may then lead you to undesirable results or undesirable situations. So now insurance comes in as a risk transfer mechanism to say, I now want to transfer this risk of me failing to achieve my objectives to another party who is your insurer. So in this case, who is Zimnat General Insurance. What then happens is it then helps you to then focus on your business or to focus on your objectives. Say you are going to college, all you need to know that is I need to go through my studies and then have a qualification at the end of the study period. But now things may happen along the way, which may hinder you or which may prevent you from achieving the objective of the qualification. I'll give examples to say maybe you have got your a laptop that you have been bought by your sponsor or by the breadwinner, and that's the laptop that have got all your assignments, and you have got assignments that needs to be done. You have got all your material that is there, and probably this is just a well-wisher. If you lose that laptop, then what it means is you are not going to achieve your objectives because you may not have this the person who assisted you replacing it for you. You might be fortunate to have them replace it for you, but you don't know now the timing and you don't know when it happens, which is the uncertainty to say. Sometimes we don't really know at what particular point will this happen. So it may happen when maybe your dad or maybe your son who is sponsoring you is actually facing.
Hi, Isaac, we have lost you. Isaac, you are on mute. We cannot hear you.
Hi guys, so all along I was talking to myself, and I'm
For the
midway
last 1
through.
minute.
Oh, for the last 1 minute. Okay. That's fine. I don't know where I left, but what I was just talking about is to say the chances that you may not be able to achieve your objectives, or maybe you may get undesirable results, and then the role of insurance coming in now to close that gap. So now insurance comes in to say you then transfer that risk to the insurer, and when the risk is transferred to the insurer, you lose your laptop, then your laptop will be replaced. You lose your vehicle then will be replaced. There are a whole lot of other things that then comes with transferring your risk to the insurers. And the good thing is to say, as I've said earlier, is it allows you now to focus on your objectives, yet the issues of the risk, you transfer them to what? To your insurers. The concept of insurance started long back. And there are a lot of insurances that happens, but sometimes people may not just classify it as insurance. I'll take, for instance, those who comes from rural backgrounds, or even here, I've heard of some mobile network operator talking about having a burial society wherein you pull your monies or your contributions, then in the event that you suffer death, then the funeral costs are met from that pool. So that's the concept of insurance. It started way back, but then there has been some evolution in terms of what then insurance becomes, because way back people were just pulling resources. There were no terms and conditions, but now with the development or the changes in the world, you'd find that your insurance now comes in with terms and conditions, which is very important for you to understand what are the terms and conditions of coverage for the type of insurance that I have bought. So there are very big natural disasters that occurs. We can mention, I'm sure we all know about the Titanic in 1912. Nobody could actually think that the Titanic would sink, but then it sank. These are the unfortunate events that may happen that then hinders us from achieving our objectives. We all know about the September 11 attack in the US, the bombing of the Twin Towers. Nobody could think that it could really happen. But then when it happened, it then prevented a lot of people from doing their usual business. So at the end of the day, they could not then achieve their objectives. But the insurance now comes in to say you need to transfer the risk of these natural disasters. And what then happens is insurance is a concept of pooling, as I've said earlier on. We have pooled your resources, and it's also a risk transfer mechanism. So your insurers will then be able to share that risk with other risk carriers, so that when these events happen, then property is restored and business then continues. And then the objectives of the insured or the public will still be met. There are quite a lot of forms of insurance that you find under GI. We have listed just a few. Motor insurance, for instance, like I've said, there has been an evolution of the forms of insurance. I'll give you just a good example to say, you buy your motor vehicle, say, from Japan, and you have borrowed a loan from, or you have borrowed from a bank. So your loan financed the acquisition of that particular vehicle. So the bank, you have got a financial interest in the loan that they have advanced to you. All your banks, all your microfinance institutions, they actually buy insurance to say, should you then default, then they have got a fallback. So what then happens is you have bought your car, and your car is on its way, and then it's involved in an accident. You still have to service the loan because this is not insurable. The bank would, it's not a peril that will then be covered, so that the bank can actually recover from the insurers. So it means you still have to service your loan. You are paying installments, but then you no longer have the vehicle. So then insurance helps you now to say, when the vehicle is involved in an accident, it got repaired or it gets replaced, and in the meantime, you continue doing your monthly installments. So you have been brought back to the position where you were. So imagine having saved, for instance, for 3 years to buy a car. You buy the car, and then the car is involved in an accident, and you don't have insurance, so you no longer have the car. Then this then affects your life. It affects your lifestyle. So the importance now of insurance is now to say there are a whole lot of other things that then comes with insurers, which are like risk management. Like, for instance, if you're involved in an accident and your car has to be repaired, the repairers will quote you, but insurers will have their own assessors who comes in to say, is this fair pricing, and is this actually what is supposed to be done to your vehicle? And because they are experts, so you don't know whether you are being given, or a car is being fitted with genuine parts or fake parts. So it's very important that when insurers come in, over and above paying back your loan, over and above restoring your vehicle, there are a whole lot of other expert advice that you then get from your insurers. There are quite a lot of things that can actually be insured, as you can see on the screen. These days, there are so many other forms of insurance that you can buy, like your personal accident, like your school fees protect. Imagine your child is learning at a private school, and they are paying you are paying $3,500 a term, and then you get injured or you die, and your child is probably first term Form 4. You still need your child to finish their studies at a school that you prefer. So your insurance will then come in to pay the balance of the school fees. So it means, regardless of what you have, the unfortunate events that have happened to you, your child will still achieve or realize their dream as they will continue their education. Imagine you are traveling, there are a lot of things that can happen. You can lose your luggage, you can be involved in an accident, you can fall ill whilst you are in the US, for instance. There is no one there to say, no, can you give me money so I go to Parenyatwa, or so I go to Avenues, and then I'll sort you. You are there on your own, your travel insurance will kick in. Hospital cashback, for instance, you are admitted, there are a whole lot of other things that you need as a result of your admittance in the hospital. You probably need extra cash to cover for the medical expenses. Even if you have got medical aid, you still have your co-payments, you have your shortfalls that you need to pay. And also probably need additional security at home. So you actually paid cash whilst you're hospitalized. So it then improves. Sometimes, when you recover because of the peace of mind that you then get to know that my children are safe at home because I now have additional security at home whilst I'm in hospital. Or your children or your mother will not get to worry to say, when I'm visiting the hospital, what am I carrying? So insurance kicks in. quite a lot of other commercial lines that you then buy. Everything that you can see as you are working is actually insurable. I'll give you an example. Like those who are following the news, like we have got drought this year. There's an organization called Africa Risk Capacity who are actually paying more than 8 million to cover for the losses of drought. So as Zimnat General Insurance, we cover all forms of property and casualty businesses. That includes agriculture. You'd find that we are the biggest agriculture insurer in the market. So should there be excessive rainfall, you know that my crops are covered. Sometimes imagine you would have obtained a loan and you have got even your field here, what do you call it, peri-urban farming or the urban farming. You have got a small field, you borrow your money, you buy your fertilizers, your chemicals, and then there's drought, for instance, or there's excessive rainfall, or maybe it's attacked by pests. You still need to service the loan, but at the same time, you know that I'm going to recover from insurance. Imagine you have got, or you are starting your farming business and you've got your 2 hectares of tobacco and you obtained a loan, whether from an employer or from the bank. But then if hail strikes it, you still need to service that loan. But at the same time, remember, you still needed to achieve a certain objective of having additional income. So your insurance will then what? Will then kick in. You know, so basically the goal for general insurance is just to say you should never get broke. How does that happen? You know, certainly your premium in advance, and you know that I've got my assets and my assets are covered. So you have transferred the uncertainty to the insurers to say, I don't know when I will need to repair my vehicle. I don't know when I will need additional school fees. I don't know when I will fall ill. So what then happens, but you know the premium that you are going to be paying, and the premium is very insignificant. Why do you pay low premiums? Is because you are pooling your resources, just like what people do in the burial societies. So your resources are pooled into one pot. So in the event that you suffer a loss, it means you are subsidized by the other people contributing in that particular pot. So you may not suffer losses for 5 years, but someone may suffer loss from insuring day one. Then a few hours later, you suffer a loss, and then you get paid from that pool. So what then this means is you never get broke, because you know certainly that I want to pay a premium of $5, but you don't know how much you would need one day to recover, to replace your stolen TV or to repair your vehicle. So what it means is you'll be able to live a peaceful and stress-free life, knowing very well that I am covered. Whatever happens, if lightning strikes, you know that I'm covered. As all you just need is to make sure that you are safe, so that you'll be able to submit your claim to your insurers, and then they come in. There are various other things that then helps you from Zimnat perspective. If you're insured with Zimnat, Zimnat is the highest rated insurance company in Zimbabwe. There's an organization which rates the financial stability and the financial capabilities and the resilience of insurance companies. Normally in Zimbabwe, we use one called GCR ratings. So GCR ratings have awarded Zimnat the highest financial strength status. So any insurer that you hear in Zimbabwe is not as strong as Zimnat is. So this then further gives you the peace of mind to say, because sometimes there is what we call also counterpart risk, to say you may be insured. There are a lot of other insurers that you'd find on the market. But then if you are insured, if you suffer a loss and the loss is covered by your insurance, but the insurer is not the means to pay that, they don't have the funds to pay that, they don't have the money to make good the loss. So it's as good as you are not what? You are not covered. So it's very important also from an insurer selection perspective to go for those that have been accorded the highest ratings as far as their financial strength is concerned. So you find that when you are at Zimnat, you know that your valuables are protected. You can keep calm in the event of a crisis. You know that tomorrow you are sorted. Your life is actually transformed, is actually made better, because you can live your best life knowing that everything that you have is covered. I'll just point, like I've said, to say it's not much actually when you look at it from an insurance perspective that you then pay. You pay very little. I'll give you an example like what you are seeing on the screen, to say if you've got a vehicle for 5,000 and you want what we call comprehensive cover, you can pay as little as $220 per year, which you may even pay in installments. You can actually pay this over or 3 times a year, which we call it termly. You can break down that 220. You can even pay monthly. You can even pay semi-annually. So look at it. If you are paying 220 per year and you want to break that maybe into 4, so that's only $55 that you are paying after every 3 months. What we then do from a Zimnat perspective, as you have heard before, Zimnat is a broader group. We actually have a financial services arm of the Zimnat group, which actually can finance your premiums. To say you go to them and say, you know, I want my property to be covered, but I don't have the premium at the moment. So can I have $55? Can you pay that 55 to Zimnat General and then I'll pay you monthly? Imagine if it is $50 and you are paying over 3 months, that's like less than $20 that you are paying. So we have got all these arrangements, and we've got partnerships with several like-minded organizations where we can actually help you not really feel the burden of insuring. But I tell you, if you ask those who have involved in an accident, they will tell you the importance of insurance. You would find that if you have got a house, for instance, a 100,000 house, you know what happens, the floods, that the lightning, you know, the fires that occurs. And imagine if you are paying $126 per annum. This is not even enough to pay your bills. I'm sure even your seat of Harare, seat of Kadoma, whatsoever where your house is, you are not even paying as little as $126. And just imagine when you pay this, and when the extreme weather events occurs, you know that my house is going to be to be restored. So what is very important now, the essence of this, why we're having this discussion, is for you to be able to plan. So if you plan wisely and you pay for your insurance, you will be happier. You will be guaranteed that you will be smiling tomorrow, and you are certain that you are going to achieve your objectives. You leave the business of managing risks with the insurers, and then you concentrate on your core business. So, ladies and gentlemen, it's been a pleasure that I've been talking about. I didn't see the questions. I was hoping that this will be interactive, but when or as I conclude my presentation, you would want to see that there's actually more that we can talk about insurance. There are a lot of things that you don't think are insurable, yet they're insurable. So our offices are always they're manned by professionals who are able to have a discussion with you about your insurance needs, to ensure that you maintain your peace of mind, to ensure that you achieve your life objectives, to ensure that you achieve your corporate objectives. So whatever you have that is property or that is cash out. When you talk about cash out, we are talking about even the liabilities. You know, you can be walking in town, you know, you even by foot, by mistake, you can knock someone's glass, a shop window, and it's knocked. Maybe you're holding an umbrella. If you have got your public liability, you know that my insurer is going to come in. It's my personal liability. I'm guilty to restore this. So it's important that you just fill in your claim form. Your insurers will pay for that. So you walk freely. You are not afraid, really, of doing whatever that you want to do, as long as you know that you are insured. Ladies and gentlemen, I thank you.
Thank you so much, Isaac, for the thought-provoking insight. Ladies and gentlemen, Isaac spoke to us about the importance of having insurance. Have you ever thought about what is going to happen to you in the event that you pass on? Have you ever thought about what is going to happen to you in the event that you are involved in an accident, or even when you are admitted in hospital? So that is where we come in as Zimnat to offer financial solutions so that you can have peace of mind. Isaac, thank you for that. I see in the comment section, there is a question for you. What is Zimnat's standard turnaround time for settlement of claims, all things being equal?
Thank you very much for that interesting question. What we do at Zimnat, it will not take you more than 5 days before you receive your payment, or before you have authorized that your repairs be done for your vehicles, for instance, or for whatever asset that you have, your TV, your laptop, and whatsoever. But what is very important, because there is need for cooperation between you, our client, when you have suffered a loss. What is important is to say all the information needs, the information requirements are submitted, because what normally then delays the claim settlement is when all the information has not been brought to us, which then made it very difficult for us to proceed with the settlement. So what we always encourage is to say, at the point of taking your insurance, just be sure that our dedicated employees and agents and distribution partners, they answer questions, especially like these ones, so that at least you know your rights. We also encourage you to go through your terms and conditions. We also encourage you to go through your policy wordings so that you know what to do when a loss occurs. We have had situations where someone can suffer a loss. Like, for instance, if you suffer a motor vehicle a loss, whether it's an accident, we all know that the law requires that you report that to police within 24 hours. And our terms and conditions are that you need to report to us, you need to notify us within 30 days. And there are standard documents that you need to hand in together with your claim to ensure that your claims are settled timeously. So we would not go for more than 5 years without a settlement if you have provided all the information that is requested at the point of submitting your claim.
Thank you, Isaac, for that. Indeed, Zimnat makes our lives better. I see there's a hand from Kamuchirai Maziva. Over to you, Kamu, with your question.
Thank you very much. Thank you very much, Isaac. I've got a question for you and another question for Simba. I just wanted to find out from you, Isaac, for the home insurance. I just wanted to find out if for the home insurance, I just wanted to find out if there are any specific exclusions or limitations in the policy that we should be aware of for home insurance. Thank you. And for Simba, I don't know if I should also say my question now, or should I wait for a bit?
Please go ahead, Kamu. Simba will take note of your question and he will respond after Isaac.
Thank you, Evelyn. For Simba, you mentioned tax benefits that may come with financial planning tools like unit trusts. Can you explain further how? Thank you.
Thank you, Kamu, for the questions. Isaac, I will hand over this time so that you can respond to Kamu's first question.
Thank you, Kamu. Yes, there are exclusions that we have on your home owner's insurance. When you talk about home insurance, we have got basically two types. We have what we call homeowners, which is like your building, but we also have what we call household or house contents or in insurance. So there's the exclusions. We have got specific exclusions for the contents and we've got specific exclusions for the homeowners. But generally, what happens is on almost all the exclusions, what is important for you is to say, we want to cover things that are fortuitous. That's number one. Then also we exclude things that are insurable under other policies or standard policies of insurance. Then I'm just trying, because there are many, so I'm just trying to give you categories of the exclusions that you would find on our policies. Then we also have things which arise, or losses that arise as a result of negligence. We always say that you, as the insured, you have got a duty to act as if you are not insured. So what therefore this means is we need to be sure that whatever that happened, it was fortuitous. There's nothing that we could have done to prevent it. So you'd find that we will then exclude losses like somebody you leave your house unlocked and then just someone just walks in and do harm, and you suffer a loss as a result of you not having locked up the house, which generally is to say, if you are not insured, ordinarily would you then have done that? So the exclusions that you'd find are to do with negligence or things that you could have done to prevent the loss. In a nutshell, I think those are the specific exclusions that you would find, because we are saying on your house insurance, if you leave your laptop is covered under house contents. So if you lose your laptop, for instance, and you have not insured it under your contents, then it's an exclusion. It will then not be covered. Or maybe when somebody constructed your house, and when they constructed that house, they have left some defect which you can then prove to say, if this house was supposed to have a special foundation, for instance, and then the special foundation was not done, despite that the laws says this needed an engineer to certify that a special foundation is in place. So when then you suffer a loss and then your house cracks, then you will not be able to cover that. There are also losses that you have to do, which are not spontaneous. There are losses that then occurs over time, like your normal wear and tear. To say, when then say your gutters over time, they then develop, maybe they accumulate some sand, they accumulate some manure, maybe your house is under trees, and then your gutters then fall off the roof. Then we then say this is gradual. It's not it's not something that is accidental. There are quite a number of issues that you'd find that would then not be covered, especially those to do with losses that occurs over time and to do with the negligence on your part, or the losses that would have been caused by somebody that you have contracted. For instance, you have someone performing a specific work at your premises. We then say, if somebody comes to do an extension to your house, for instance, and they cause a damage, we are saying that person needed to have their own insurance to cover for that. So we cover things that are fortuitous, which are accidental, and there's no negligence on your part. You would find that there are certain losses that we then say, okay, fine, you were negligent, but you could not have avoided this particular loss. So we come in and say, okay, can you also contribute into what? Into the reconstruction, for instance, because you could have done A, B, C, D.
Thank you, Isaac, for the response. Ladies and gentlemen, I'm sure you can agree with me that at Zimnat, we do have insurance experts. So please do visit our offices so that we can engage with you and offer you financial solutions. From the chat box, there is one other question for you, Isaac, from Chikwanda Munyaradzi. He says, with motor vehicle insurance, you can religiously pay for a good 5 years and not claim anything at all. Does Zimnat look at this to reward such policy holders, e.g. cashback?
We do have rewards that are associated with good behavior or good claims ratio, good performance of portfolios, but it may not come to you as actual cash payment. I'm sure even those who are in this particular, you know what we normally do at the end of almost every year, we do some rewards. But the rewards could be your rate can actually be reduced. So for instance, if you were paying, say $200 a year for the 5 years and there is no claim, you would find that Zimnat can then say from now onwards, instead of you paying 200, you are now paying 190, or you are now paying 180. Or Zimnat can say at the end of the year, after your 5 years, they can say, oh, okay, thank you, Mr. Chikwanda, for good behavior over the 5 years. Here is a grocery hamper, or here is say some fuel, this is a vehicle, maybe some fuel coupon, or can say there's a contribution that you make on each and every loss. For instance, if you suffer a partial loss, maybe it's just it's an accident, you hit an object and then there's an excess, which is normally the standard is 10%. Zimnat can then come and say, instead of you paying 10%, then you pay 5%, but this will be done at renewal. So in terms of the cash settlement, you may not get the cash settlement, but you may actually get a discount for good behavior, or you can get a hamper, or you can get some goodies, or you can be invited for lunch or something along those lines. So indeed, we do reward good behavior. We do reward good loss ratios.
Wow, thank you for that, Isaac. Ladies and gentlemen, those are great rewards. Simba, I do have questions for you in the chat box. The first one is from Ngakuzwe. Ngakuzwe is saying, I have a question for Simba. How practical is it in our environment to pay off small debts first before the big ones, given the current inflation rate?
Thanks so much for that question. Maybe before I answer that one, I will first address the one that I've noted from Gabuchirai Maziwa in terms of tax benefits. So there are certain products that are registered with the Insurance and Pension Commission that have got tax benefits, and they are basically personal investment vehicles. So if you invest in such vehicles, you then get that tax benefit. So for example, if you are invested in a personal pension plan, if there's a vehicle in the market, or even through us Zimnat, that is available, and it's a personal pension investment vehicle, and you invest in that. What it means is if the income which is going into your account, for argument's sake, let's say it's 1,000 USD. What it means is if from that 1,000 USD you are paying insurance, or you are paying that you are investing in that personal pension vehicle, and you are paying $100 every month. What it means is you have paid. You can actually redeem some bit of money from the taxman, because instead that $100 which you are paying towards the pension should have been deducted first, so that your net income becomes $900, and your tax is calculated on the 900, so that you actually pay less tax. So Zimra actually allows you to complete certain forms, which you then send to them, and you then get that tax refund. So that's what I meant by the tax benefit that you get when you invest in certain in certain investment funds. So it's not all investment funds, but it's those ones which are registered for pension. And one such is the product that I can think of from the top of my mind is a personal pension fund, and some other personal life assurance plans, where you have taken out a life assurance policy for your own life using your own funds. You can actually then get those forms from Zimria. You do the applications, let's say at the end of a financial year, then they pay you back whatever that tax should be. Or they then work out an arrangement whereby maybe when you pay your next tax obligations, you then get that benefit when you are paying for the next year. So that's how it operates. Then the other question from Gakuzwe, in terms of how practical it is to pay off small debts, using that debt snowballing effect. So, Zim really is an interesting market where we are using a basket of currencies. But if you consider the USD side, if you've got USD debts, let's say maybe you have got a mortgage, you are paying, the total mortgage value is maybe 30,000, you are paying 400 per month. Then you have got another loan, maybe say 2,000 loan, where you are paying $100. So technically you are paying $500 every month. But if you quickly, pay off the $2,000 loan, what it means, you have now more muscle, and you can actually up your repayment of the mortgage. from $400 to $500, which will actually then allow you to pay off the higher debt quicker, because you've kind of paid off the lower debts faster. But the situation then changes when we look at the local currency. That is, if you've got debts in ZWL. So I'd kind of, just generalized it from a USD debt angle. Thank you.
Thank you, Simba, for the responses. There is one more question for you from Gamuchirai Sibanda. Thanks, Simba, for the insights around financial planning. Recently, South Africa introduced the two-pot system for managing life investments. Is it applicable?
Oh, okay. Thank you, Gamu, for that. So South Africa has made some major changes in terms of their retirement law, their pension laws, and they've introduced what they are referring to as the two-pot system. It's not yet applicable in Zim. Zim, we've got our new act, which also came into effect 2022, September 2022, and it didn't include that. So I don't think, maybe for us, we might be having the two-pot system anytime soon for Zim. But basically, what they are doing now in South Africa is for your pension fund, you know that normally one enjoys their benefits from their pension when they retire. But South Africa, they've restructured the pension in such a way whereby there's an investment. So there's the pension pot. Within your pension fund, there's what they are referring to as more like as the retirement part or portion, or retirement pot, and the savings pot. So the savings pot, you can actually access it anytime. I think they are saying once a year you can draw down from the savings pot. So it becomes more like a savings account where you can draw down. Whilst it's good, the disadvantage is what will then be left out towards your retirement when you reach retirement will be quite small. So it's not something which is yet applicable in Zim, but that's how they are doing it in South Africa. Possibly in the near future, maybe five years to come, we might also be having such changes in our legislation. Thank you.
Thank you, Simba. I see we have one hand that is up from Kimberly. Kimberly Mpofu, please go ahead with your question.
Thank you so much, Eve. And I would like to thank the speakers as well for the insightful presentation. It's more of a contribution, not a question. That as a young adult, there's a book that helped me manage my money better. It's called The Broke Millennials. I think the audience can learn one or two things from this book. It will help you navigate the complex world of money management. So that's what I wanted to say.
Thank you, Kim, for that contribution. Are you going to be sharing with us the book? Thank you so much, Kim. I see that
Yes, I will share the book in the chat.
Thank you, Kim. I note that we do not have any more questions from the audience. Thank you so much for joining us in this insightful session. Our speakers were very powerful and they left with us key challenges. My major key takeaways from the speakers were the challenges that they have left with us. Number one, Simba spoke about us having a financial plan. Brian spoke about us transforming from being an impulse buyer to a conscious buyer. We also had Isaac, who spoke to us about the importance of insurance. Ladies and gentlemen, thank you very much for joining us. I will hand over this time to Tatenda, who's going to give us the closing remarks. Over to you, Tatenda.
Thank you very much, Eve, and thank you to the speakers. I think there is nothing more to add based on what you've said. I would like to also take the opportunity to thank our guests for making the time to be with us. And it is my hope that we've left this engagement with some action points and some value adding insights to help us stretch our salaries as we plan for the future. We look forward to meeting you again in the upcoming sessions. Thank you. And if you promised us some exciting prizes, we hope this will be distributed soon enough. Thanks again. Do enjoy the rest of the day and happy planning, happy financial planning.